are in listen-only mode.
Welcome to the Kevin Davis Insurance Directors and Officers Liability for Community Associations webinar. My name is Sherry Branson, and I'm your host today. The following webinar is an introduction to the Kevin Davis Insurance Company and contains an overview of all of our products. As I mentioned, I'm your host, and Kevin Davis, the president of Kevin Davis Insurance, will be the main presenter. We'll be covering the fact that Kevin Davis Insurance specializes in community association insurance products. We're going to be covering directors and officers liability, crime, and umbrella. And at the end of the webinar, we will be having a Q&A where you can type in your questions. If you see on your screen, there's a questions box. You can type in your questions. I'll be reviewing the questions, and at the end, we'll go over as many questions as we can to answer your questions, and if we can't get to you during the webinar, we can always contact you later to answer your questions. So thank you for participating today, and we are going to be having these for the remainder of 2013 each month. Now, to give you a little bit of historical background and some information about his products, here's Kevin Davis. Welcome, Kevin.
Thanks, Sherry. I'm glad to be here today. A little bit about Kevin Davis Insurance Services is that I personally been handling directors and officers insurance for community associations for about 30 years. My first directors and officers liability policy for a condominium was in 1981, when there are only a few thousand associations across the country. Now, there are over 300,000 associations across the United States. In the year 2000, I started Kevin Davis Insurance Services because I wanted to work more exclusively with community associations. I felt that I could be more effective in providing the types of coverages community associations needed because I understood the exposure associated with them a lot better. We now write over 30,000 associations in the United States, about 10% of the entire marketplace. This makes us one of the largest writers of community association for D&O in the country. Unlike our competition, we only specialize in community association-related insurance products. We don't write any other type of business. We don't write apartments. We don't write foundations, libraries, or any other type of corporation. We specialize in community associations only.
And Kevin, can you tell us, has the economy impacted rates in the industry? Have you seen a difference?
Well, yes. The community association industry is the housing industry. So, yes, it's definitely impacted. The economy definitely impacted community association across the board. Claims are on the rise now because boards can't collect assessments timely. Employees in these community associations are being laid off or terminated, and these contracts that the board of directors enter into are being canceled without cause. As a result, what you're seeing now is our rate increases about 10 to 20%. And now coverage is also becoming more restrictive, and deductibles are a little higher, especially in one area of employment practices where coverage deductibles have increased from about $1,000 to $5,000 to $10,000.
That's quite a jump. Kevin, can you tell us, is there one type of D&O policy on the market, or are there different types of D&O insurance?
Well, there's different types. There's no standard D&O contract out there. There's all different types. But there really are in two different categories. The first category is the bundle or package D&O policy, where you include coverage by an endorsement to their property and liability policy. It's usually at a lower cost, but coverage is very restricted. They typically exclude things like discrimination, breach of contract, and the big exclusion is non-monetary damage claims, which is our largest area of claims that we see today. They are normally excluded under the package bundled policy. That's why what we always recommend, is a standalone D&O contract. Now, what we did is go one step further, and we made a standalone D&O contract designed specifically for community associations, where the standalone extends coverage not only to the board members, but also your volunteers, your committee members, and the community association manager. It's designed for community associations exclusively.
And what type of policy does Kevin Davis Insurance carry?
Yeah, and what we do is our D&O that we have is a specially made policy because we looked at all the exposure associated with living in a community association. And what we wanted to do is make sure and guarantee the fact that when the claim comes in, the likelihood of the coverage is greater under the policy that we have versus the policy of our competitors.
Okay. And Kevin, can you explain what exactly is a community association for the audience?
Well, when we talk about community associations, it's a lot different than talking about any other type of nonprofit out there. Because a community association is where you live. It's not where you work, it's where you live. And you, on a monthly basis, pay assessments to the board of directors, who manages and maintains the common area of the association. So when you live there and you don't obey the rules, or you live there or you don't like the rules, you're going to challenge the board's authority. So when you have a D&O claim today, the D&O claims are not financially driven like most D&O claims in most areas. The claims are emotionally based claims, where you're upset because you want to have a pet, you want to park your car where you want to park at, you want to put things on your balcony. However, the board of directors come in there and says you can't do your job. So basically, for the board of directors today of condominiums, D&O is peace of mind insurance. Because community association board members make these decisions, and then you have unit owners, you have other board members, you have renters, you have contractors, you have the management company people. They don't like decisions you make, and then they file a claim against you. What D&O does is offer defense for these type of claims for board members in the event there's a claim against them for a wrongful act in their role of managing the affairs of the association. The key term here is a wrongful act.
Kevin, can you explain what is a wrongful act exactly?
Okay. When you talk about D&O insurance, you're insuring the board of directors or the insured against a wrongful act that he committed. And a wrongful act is any act, error, or omission that the insured can be held legally liable for. Okay? Now, often we're talking about in community association there are conflict of interest, or failure to abide by the governing documents, or failure to properly handle elections, or failure to enforce the rules, or enforce them unfairly, or failure to properly manage the association finances.
Okay. And can you tell us, can you define an insured? Who exactly is an insured in a D&O policy?
And that's what we're saying. It's saying that, you have to be a wrongful act, but you have to be an insured who committed the wrongful act. And an insured is any person who was or now is or shall become a duly elected or appointed director, officer, or a trustee of the insured, okay, or an employee, committee member, or volunteer. But we also want to make sure we extend coverage to the manager, the person who helps or assists the board of directors in making decisions to enforce the documents.
Mm-hmm. Okay, it covers a wide range. And now, Kevin, can you define a claim under a D&O policy? How would somebody recognize what a claim is?
Okay, in a D&O policy, a claim is broader than a lawsuit. One of the problems that you see is that most people wait until the lawsuit comes in, but a claim is actually a written demand for monetary or non-monetary relief. It's a civil proceeding commenced by a service of a suit, a criminal proceeding commenced by return of indictment, a formal administrative order against the insured. So it can be a piece of paper, a letter addressed to the board of directors about the failure of the board to enforce pool hours. That could be a claim. So when there's a claim out there, if you think there's a claim, then it probably is a claim. And one of the most problems that we have right now, the most common reason for declination out there is late reporting of a claim. So if you believe it's a claim, you have to report the claim.
Okay. And what do you see, what types of claims are most common under a D&O policy?
Okay, you see up here right now, these are the three most common type of claims: breach of fiduciary duty, breach of contract, and employment practices. Right now, you're talking about most of the claims that you see fall under this breach of fiduciary duty thing. All decisions made by those responsible for running the affairs association should be covered under the D&O because it is about the decisions. When somebody doesn't like decisions you make or decision is being challenged, they're going to challenge under the breach of fiduciary duty. If they don't believe the board made a decision in the best interest of the association. For example, We've had a claim recently where the board has a strict no pet policy and forced the owner of Unit 12 to get rid of his favorite dog, Max. The unit owner felt the rule was unreasonable because Max is a comfort pet and has a doctor's note that says he's a comfort pet. So that unit owner then files a claim against the board for breach of fiduciary duty, and at the end of it, we end up paying $22,000 just to prove the fact that, yeah, Max is okay to be allowed, even though there's a strict no pet policy in the association. Another type of breach of contract claim also comes from the fact that, you know, as board of directors, there's certain state laws that says you have to have 3 bids to get work done. Well, the board failed to get 3 bids, and he got 1 bid. They were sued as a result. Again, we had to pay $17,000. These are what we call breach of fiduciary duty type claims. The second area that we see is breach of contract. Breach of contract is really interesting because really breach of contract should not be covered under the D&O policy because it is an intentional act. You can sit back there and say, we're no longer going to honor this contract. You intend to do it. However, what happens is in community association, it happens. Board of directors will get involved in a situation, usually involving repairing or replacing certain activities by a contractor. You know, we see it with painting contractors, roofers, elevator repair, cable, whatever it is. You know, when an agreement is not honored, they come back and file a lawsuit. For example, you know, we had an association has a contract with the landscaper, but the board believed the landscaper missed a couple of his appointments, didn't come up in a timely manner, as defined by the contract. And then he terminates the contract, hires a new landscaper. So the original landscaper files a lawsuit against the association for not fulfilling the contract. We have to go in and defend it, and we end up paying $15,000. So those are the kind of claims we're talking about. But right now, probably the biggest claim that we're seeing, the most expensive, and that's in the area of employment practices. If the association has employees, this is one of those claims that we're seeing more and more and more of. This includes wrongful termination, sexual harassment, and discrimination. These claims are expensive and excluded by most policies. I mean, one simple one that we had recently, an association terminated a 72-year-old employee, and then they go out and hire several young individuals to maintain the gate and a security booth at the entrance to the association. Obviously, the older security guard comes back and sues for age discrimination. Now, if you want more information about our claims, our top 5 claims, we have them in video. We have like 1-minute, 2-minute videos, and you can go on YouTube. They've been videotaped. They're on YouTube. You go to youtube.com and go under KDIS online, and you can see our videos.
Thank you, Kevin. This concludes our Directors and Officers Liability portion of the webinar. And now we're going to move on to our crime coverage. Kevin, can you tell the audience what exactly is a crime policy for a community association?
Well, like it says here, a crime policy pays for loss or damage to money, securities, and other property caused by theft by an employee of the association. The 2 key words here is what is a theft and who's an employee under the policy. A theft is an unlawful taking of money, securities, and other property to the detriment of the insured. So somebody stole something. It's stealing, okay? Pretty obvious. More importantly, though, is who's an employee under the policy. Under most policies, an employee is somebody compensated by wages, salary, or commission. In the business that we operate in, you have a board of directors. Those board of directors are volunteers. So you have to really make sure you extend coverage to non-compensated board members because they're the ones who are watching the money. You also have to extend it to the property manager also because they have access to the funds also. So when you talk about what is a crime coverage and why it's so important, it is the definition of who's an employee more so than anything else. You have to be compensated by wages, salary, commission, and be non-compensated in order to be a true crime policy and benefit community associations.
Mm-hmm. And Kevin, can you tell us what other types of crime coverages are available out there?
Okay, when you look at this list here, you look at employee theft coverage, employee theft of client property, forgery alteration, premise transit, money orders, computer crime. These are all the coverages available when you buy a crime policy. However, the most important today are your employee theft coverage, which is automatic, but you also have to have forgery and alteration and computer crime and wire fraud, wire transfer fraud. Because what we're seeing today is those type of coverages. Because of our computer systems and technology, we're starting to see all different kind of things that's happening that we've never seen before. We've never seen historically a depositor's forgery claim before. But because somebody can walk into your office, get business cards, and duplicate your business card, your logo, on checks, go to the bank, and get them cash, you end up seeing depositor's forgery claims for the first time ever. You're starting to see computer fraud claims and wire transfer fraud claims today, and we've never seen them before because it's easy to do certain things that we've seen. So right now, employee theft is mandatory. If you can get employee theft of client's property, it is important. But you got to make sure you have depositor's forgery, computer crime, and wire fraud transfer.
Great. Thank you, Kevin. So now you're seeing the trends. The wire funds transfer is a trend. Invoices. Could you explain the other crime situations that come up that the policies cover?
Sure. The wire fraud transfer is interesting because what happened, here's an example of a claim we had. An association treasurer in Maryland received an email that contained a virus. The virus obtained the user's ID and password to the condo's bank account. An electronic wire transfer initiated in California, which cost $147,000 to be wired to a bank in Arizona. They did not have wire funds transfer coverage and pretty much lost a lot of money. They did end up getting some of that money back, but it took them a long time. They were out at $147,000 for a period of time. You see a lot of fictitious invoicing out there being done. We had a situation where a condo owner embezzled about $12,000 by generating and approving a payment on a series of false or inflated invoices for a roofing contractor. These kind of things we start to see more and more. Unauthorized use of credit cards. Those are happening because now the associations all have these credit cards. So we had a maintenance supervisor who made unauthorized charges on his credit card at Walmart in the name of the association. One more interesting thing is the theft of property by an employee. We had a situation where two former employees had two big giant trucks pulled up to an association's under development and installed 52 appliances from the insured property. That include dishwasher, ranges, 26 refrigerators, washer, dryers, everything that was just recently moved into the association itself. These by two employees of the association. So what we're seeing here are things that we've never seen historically, and now becoming a major, major problem that we're seeing across the board.
And Kevin, do you think that the economy is impacting the crime, the levels of crime that you're seeing and the number of claims, like as you mentioned before?
Yeah. And that's the seem to be the problem that we're seeing right now, is that today what's happened is that people who manage associations or manage this business, what they're doing is they look at their finances with a fine-tooth comb. When the companies had made a profit historically, they didn't care as much how much money we're losing. Now that the margins are so thin that they're looking for all type of situations in order for them to make money. So they're looking and finding out that there's money missing. And the biggest problem that we're seeing is once they determine money is missing is the limits are inadequate. There's not enough money in the association to pay the claim. Most of the limits out there are about $25,000. What we do is sit back there and recommend that you end up getting a crime policy in the area of 3 months of the assessments plus the reserve account. So if you do that, then you pretty much have a pretty good limit amount if there's a claim. So again, it is 3 months assessments plus the association reserves, and then you're okay. You have to also make sure that the management company is covered because they don't want to have access to the operating account. Okay? And you have to watch out for one thing, is that once you committed a dishonest act in the past, you cannot be bonded again. We have situations out there where the board of directors hire a management company, and the management company is known that committed dishonest act, embezzled funds from other associations in the past, but people either like that person or they're inexpensive, so they end up hiring them again. Once they hire that person again, which is okay, they cannot be bonded. So you have to make sure that person is excluded from coverage. So I guess the key things is make sure they have the limit, make sure that people are covered and you have the proper coverage there on the crime, and that prior dishonesty, because that seems to be a bigger issue more and more, because a lot of these management companies out there who are back in business, who come back in business, they're still making restitution to old companies. So just be careful for that kind of thing.
Mm-hmm. Well, thank you, Kevin. That concludes our crime portion of the webinar. And now we're going to move on to umbrella liability. Kevin, can you explain, are all umbrella policies that are out there alike? Are they similar? Or what should somebody be looking for in an umbrella policy when it comes to a community association?
Well, and an umbrella policy is really important today because, again, the economy has dictated that people are suing more and more and more. And as lawsuits go up, so does the judgments go up. So now all of a sudden where $1 million a limit was historically accurate, was enough, now you need higher limits. We're seeing now umbrellas go into the $20, $30, $50 million, $100 million umbrella policies out there. So what we've said, what we've done was sit back and put together an umbrella policy that, first of all, can go up to $50 million, but also goes over the D&O policy. So it extends over the D&O because most umbrella policies do not go over the D&O policy. Not only it goes over our D&O, but we make sure that it goes over the EPLI portion of the D&O. Because a lot of times you have an umbrella that goes over the D&O but will exclude EPLI. We make sure it does both. We make sure it's not only a follow form, but a true umbrella that covers both parties. We have a minimum limit of $5 million, and that $5 million is about $1,200. We agree right now that all the associations out there should have an umbrella policy, and they probably should have at least a $5 million limit because, again, these awards, the damages are increasing over $1 million.
Mm-hmm. And especially if they have swimming pools and lots of amenities, right, Kevin? That increases the risk.
Exactly. That definitely does.
Great. Well, thank you. Thank you for covering the directors and officers, the crime, and the liability. And Kevin, would you like to mention who the carriers are that Kevin Davis has for all the different products that they carry?
Sure. For the D&O, it's Travelers, and the crime is also Travelers, and the umbrella's under XL.
Okay, great. And how would somebody, if there are any new brokers listening today, how would they go about getting a quote? Where would they go to?
Right now, I recommend them go to our website, which is listed up there. You can get producer agreements. You can learn a little bit more about what we do and how we do it. Feel free to do it at any time.
Mm-hmm. Okay. And let's see. Great. Thank you. And let's see. I have a question here. If I have an insured that is a non-renewed by their current carrier and they elect to renew their $3 million D&O coverage with KDS, why does KDS not offer a $3 million limit as the previous carrier? KDS requires the insured to purchase a $1 million and a separate umbrella to make up the additional limit.
Well, the premiums under the D&O are pretty low. I mean, you're talking about maybe $1,000 for a $1 million limit. The problem is when you have a $1 million limit and a $1 million loss under a D&O for condominium, that is a huge loss. Most of the coverages, most of the claims that we see, because we're not talking about big financial losses, we're talking about the right to be able to park my car where I want to park the car at, or the right to be able to go swimming in my pool anytime I want to go swimming. So when you have a D&O claim, a $25,000 or $50,000 or even a $75,000 claim is normal. When you see a $1 million claim, that is abnormal. So we don't want to see a $3 million claim. You know, that would kind of wipe us out. So we can provide a $3 million quote, but our first preference is to give you a $1 million and to find an umbrella for you. However, we can do a $3 million. We just believe at this point in time that when we have a claim and and it's a big claim, it's going to really impact rates overall for all of us, because that $3 million loss will impact the rates to the point where right now they're going up 10, 15, 20. They may ever go up even a lot higher than that. So we like the $1 million. Like, we feel very comfortable in that $1 million area. That's all. It's more comfortability.
That makes sense. That makes sense. And Kevin, we have another question. Why does Kevin Davis Insurance require a signed membership agreement each year for just the umbrella?
Well, it's really a protection for the people who, the insured itself, and for everybody. I tell you though, it's one thing I will take a look at, something that we agree that maybe you should have it every 3 years, and that's something we need to look at a little bit more carefully, and I agree with that one. But right now, it's something that we believe is in the best protection of everybody, but we need to look into that. So I'll make a note of that one. That's a very good question.
Okay. And we have another question. If you have an employee that steals over the course of multiple years, do multiple policy limits apply?
Well, that's a good question, because the crime has gone from a loss-sustained policy into a discovery policy. So during a loss-sustained policy years, it can provide coverage over a series. You can have a crime loss over a series of years, and it can impact 2 or 3 different policies from that time period. However, we're going to a discovery period where now it's all going to fall into one policy period, 1 year. Whoever the current carrier is, and even though it's been over a 3 or 4 year period, it's all falling into that one area right now.
Okay. And another question. I noticed that a lot of the HOA policies are being non-renewed by the larger carriers. Can you speak as to why the carriers are moving off these risks?
Moving off of HOA, I would say right now, if there's a type of HOA carriers are moving off of, it's their large-scale associations. The problem with them is there's so many amenities and so many things are happening in those areas that most carriers don't understand what they're doing and how to really insure them properly, so they're getting off of it. What we've done, and I've been doing it for 30 years, is looking at the exposures and maybe excluding certain exposures that we're not comfortable with, but we're still writing larger ones. The larger type right now, we really have the biggest problem in is what's called mixed-use associations. We have the large homeowner association, but you also happen to have in there commercial buildings, retail stores, retail shops, restaurants. Those right now are your biggest, and they have lots of employees. They end up with 30, 40, 50 employees. Those are your bigger problems for D&O, because you're talking about EPLI claims, you're talking about people who don't get along with the retail operation. You have smoke coming from the restaurant that's impacting the people who live above them. So, yeah, the exposures in those larger associations are really great, and as a result, either carriers can get off of them or you're going to see higher rates. Right now, you're going to see higher rates across the board and a lot of D&O because the claims have increased.
Great. Well, thank you, Kevin. This is the conclusion of our 30-minute webinar, our first KDIS webinar, and I'd like to welcome everybody, or thank you for joining us today. And I just wanted to also mention that we're going to be having these every month. The next one is going to be February 20th, and that's going to cover some new exciting enhancements to our D&O policy. And then we also have one on March 20th, which is going to be covering rates. So, and a copy of this webinar will be on the Kevin Davis Insurance website, so you can view it again. And we didn't get a chance to get to all of the questions, but we will be contacting you to get back to you to answer your questions post-webinar. So thank you for joining us today, and thank you, Kevin.
Oh, thanks a lot. I'm glad to have done it. I look forward to next month.
Great. Have a great afternoon, everybody. Thank you.
Thanks a lot.